Okay, this is part 3 of our videos here. Part 1 just was explaining the normal balances, and then in part 2 we started these transactions. We got 3 of them done. The 4th transaction is where we are now. It says we paid rent on office and equipment for the month, $3,100. Okay, if we had a chart of accounts, we would see that we have a rent expense. Expenses over here on the left side, the debit side. So let me make up this date right here. Let's just go on and say this is on 8/10. We have a rent expense. Expenses increase with debits. So we're going to debit the rent expense in the amount of $3,100. Now, what did we use to pay for this? Well, obviously the word paid implies we have used up cash. Okay, so cash is decreasing now. So let's think about this. Cash is an asset, okay? It has a normal debit balance. If we're going to increase cash, we have to give it a debit. Therefore, if we're going to decrease cash, we have to give it a credit. So we are crediting cash in the same amount of $3,100. Okay, let's skip a line. We're going to pay creditors on account. Let's say this is 8/12. Now, let's talk about what happened. It says we paid creditors on account. Obviously, we paid money, so we're using up cash. Cash is going down. So let's go ahead and finish up cash. Cash goes up with a debit because it's an asset, so it goes down with a credit. And I'm going to go to the next line because we want our debits to go before our credits. So I'm saving space for that debit. Cash is going down by hold on here, creditors on account, $1,200. Okay, now, but why did we give these people our money? Did we get anything new at all? And the answer to that is no. We are giving it to them because we already owed it to them. Remember, we mentioned that if the term on account is there, you're either going to be dealing with an account payable or an account receivable in some way. Okay, in this case, we had something we already owed people. If you look up here on the 5th, we have an account payable. We owe for some supplies. I think what's going on now is we're simply paying off part of those supplies. So accounts payable is a liability. Liabilities have a credit balance. They increase with a credit, which is why on this line we are crediting accounts payable. But now we want to decrease accounts payable. So we are going to debit accounts payable, and that will reduce the amount that we owe. Okay, and after that it says we withdrew cash for personal use. Is it okay that the owner took money out for personal use? And the answer is absolutely yes. That's what they're in business to do, is to make cash they can pay their own bills for. However, this doesn't mean we're taking it out under the table or any kind of, you know, illegal way. We're going to track this cash. So to track the cash, we have an account called drawing. And let's set up a date. And we said it's the drawing account. So right here, drawing has a normal debit balance. So we're going to put the owner's name, Rose Tyler, and the name of this account now is drawing. And we're going to put $2,000 in here. Okay, the amount of the drawing increases with a debit because it has a normal debit balance on this left side. Now, what does the business no longer have? We no longer have that cash. Cash is going down. Okay, cash has a normal debit balance. Cash will increase with a debit. So if cash is decreasing, we give it a credit. So let's credit cash the $2,000. Okay, we're getting there. We're going to go ahead and finish this out in the next part. Let me stop this and I'll pick back up in a